Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dte Energy Company annual report. Dte Energy Company offers a diverse range of businesses and services to its customers. At the core of its operations are two primary segments, electric and gas. The electric segment provides electricity to over 2.3 million residential, commercial, and industrial customers in southeastern Michigan through various sources such as coal-fired plants, natural gas plants, hydroelectric pump storage, nuclear plants, wind, and solar assets. The company's gas segment serves approximately 1.4 million customers throughout Michigan by purchasing, storing, transporting, distributing, and selling natural gas. This segment also offers storage and transportation capacity sales. In addition to these core services, Dte Energy Company provides various specialized offerings through its Dte Vantage segment. These include metallurgical and petroleum coke supply to steel and other industries, as well as power generation, steam production, chilled water production, wastewater treatment services, and compressed air supply to industrial customers. Furthermore, the company's Dte Vantage segment owns and operates renewable generating plants with a capacity of 70 MWs and gas recovery sites. The energy trading segment engages in power, natural gas, and environmental marketing and trading, structured transactions, and optimization of contracted natural gas pipeline transportation and storage positions. Overall, Dte Energy Company provides a comprehensive range of energy-related businesses and services to its customers. Dte Energy Co.'s stock price has increased by 11.88% to 15.6% over the past year due to a combination of positive news events and developments. One key factor is the company's strong fourth-quarter earnings, which exceeded analyst estimates. Dte Energy reported EPS of $1.65 and revenue of $3.35 billion, surpassing expectations. The company's growth in the data center industry has also contributed to its stock price increase. A $1.4 GW agreement with Oracle OpenAI for a new data center in Saline Township received regulatory approval, generating bullish sentiment for utilities like Dte Energy. Additionally, forecasts of 2–3% annual electricity demand growth driven by AI operations and data center expansion have positively impacted the stock. Dte Energy's commitment to strengthening its operations is also evident through its record capital investment of over $4.3 billion in 2025. Furthermore, the company's decision to increase its quarterly dividend by 6.95% has signaled financial health and attracted income-focused investors. Analysts' optimistic outlooks for Dte Energy have also contributed to its stock price increase. Mizuho Securities reiterated its buy rating on the stock, while Jefferies maintained a buy rating with a price target of $153. The broader utility sector's optimism has also benefited Dte Energy's stock, as investors responded to expectations surrounding the Trump administration's anticipated rollback of greenhouse gas emissions legislation. Overall, Dte Energy Co.'s stock price increase can be attributed to its strong financial performance, growth in the data center industry, commitment to strengthening operations, and positive analyst ratings. Dte Energy Company maintains a market capitalization of $30 billion, broadly in line with the industry peer group. Dte Energy Company trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 2.41 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 76% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 3.16%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key points extracted from the summaries. On the revenue growth side, several factors contribute to the increase in revenue. Renewable energy is a significant driver, with an increase of $106 million. Tax credit sales also play a crucial role, with a substantial jump of $268 million in 2025 compared to the previous year. Additionally, commodity contracts, specifically natural gas and electricity revenue, saw increases of plus $112 million and plus $361 million, respectively, in 2025. Furthermore, environmental and other operations contributed to a revenue increase of plus $61 million in 2025. On the other hand, there are also notable drivers of revenue decline. The decommissioning surcharge on electric customers is a significant factor, resulting in approximately $3.1 billion in losses. Commercial and industrial revenue declined by minus 38%, minus $2,195 million, and minus 9%, minus $652 million, respectively, in 2025. These declines are substantial and have a significant impact on the overall revenue. It's also worth noting that certain segments of the business experienced growth while others declined. The electric segment saw an increase in residential and gas sales, while the gas segment primarily relied on gas sales for revenue. Other segments, such as Dte Vantage, experienced revenue declines, whereas energy trading saw growth. Overall, these trends highlight the complexities of revenue drivers and the need to carefully analyze each segment to understand the underlying factors contributing to growth or decline. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from 2023 to 2025 shows that the company has been able to produce more cash than it consumes in its core operations. This is evident from the operating cash flow figures, which have remained steadily high over the 3-year period. With a significant amount of $3.643 million generated in 2024, the company's ability to maintain positive operating cash flow is a testament to its financial health and stability. The company's debt level has undergone significant changes over the past few years. While there are instances where no significant change was mentioned, other points indicate a notable increase in debt levels. For instance, long-term debt increased by $1.4 billion, maturity within 12 months, on page 62, and by $951 million on page 90. Additionally, short-term borrowings have increased significantly from $3,167 to $4,533 on page 82. However, there are also instances where the company's debt level has decreased. For example, total debt decreased from minus $2,317 million to minus $3,142 million for Dte Energy on page 149. Furthermore, long-term debt outstanding at December 31 increased from $12,444 million to $13,441 million on page 167. Regarding interest expenses, there are instances where they have increased significantly. For example, net interest expense increased by $53 million in 2025 and $79 million in 2024 on page 41. Additionally, interest expenses have increased from $751 to $978 on page 82. However, there is also an instance where interest expenses decreased from $445 million to $430 million for Dte Energy on page 149. In summary, the company's debt level has undergone significant changes over the past few years, with both increases and decreases noted in various instances. Interest expenses have also increased significantly in some cases, but decreased in one instance. The performance of various segments and regions within the company has been analyzed. The electric segment stood out as a strong performer, with peak load and highest total system sales occurring in Q3. This segment also saw consistent revenues recognized over time based on volumes delivered, with figures reaching $71 million in 2025. The gas segment also performed well, with revenues recognized over time based on volumes delivered. The revenue figures for this segment were $22 million in 2025 and $16 million in 2024. On the other hand, the DTE Vantage segment showed a mixed performance. While its revenue figure of $77 million in 2025 is higher than previous years, the growth rate is unclear. The energy trading segment's performance was also uncertain, with no specific information provided on its performance in pages 16 and 119. However, its revenue figures did increase from $85 million in 2023 to $176 million in 2025, but it remains unclear if this trend is positive or negative. Management's views on the company outlook or strategy are centered around several key points. The company's results may be impacted by various external factors such as regulation, economic conditions, and environmental issues. However, management is optimistic about the future, expecting planned infrastructure investments to result in earnings growth and seeking to improve productivity and decrease costs. Management also emphasizes the importance of maintaining a strong balance sheet and accessing capital markets to support long-term earnings growth. The company expects cash flows from operations to increase over the long term due to growth from utility and non-utility businesses. Additionally, management is focused on managing market price risk related to commodity prices, which are uncertain. In terms of specific strategies, management has implemented master netting agreements to net gain and loss positions and uses a practical expedient for fair value, valuing assets at net asset value, NAV. The company also sets strategic goals, allocates resources, and evaluates performance based on 4 reportable segments. Overall, management is committed to improving customer satisfaction, reducing costs, and driving long-term earnings growth through a combination of infrastructure investments, cost reduction initiatives, and effective risk management. The company has made several significant acquisitions and divestitures as part of its business strategy. In terms of acquisitions, the company is actively involved in acquiring and developing renewable energy projects and other energy projects. This is evident from page 15 of the extracted summaries. However, it's worth noting that there are no specific details provided about these acquisitions, except for a mention on page 23 that Dte Energy participates in acquisitions as part of its business activities. Furthermore, page 32 mentions business combinations resulting in goodwill or allocated goodwill on page 64, but this is not a specific acquisition. On the other hand, the company has made significant divestitures in recent years. On page 32, it's mentioned that the company has retired all coal-fired generation units at several facilities, including Trenton Channel, River Rouge, and St. Clair facilities. This move is part of the company's efforts to transition away from fossil fuels and towards cleaner energy sources. In addition to retiring coal-fired units, the company also plans to retire remaining 5 coal-fired generating units, including the last unit at Bell River in 2026. Furthermore, the Trenton Channel facility will be repurposed into a battery energy storage system in 2026. These divestitures are a significant step towards reducing the company's carbon footprint and aligning with its sustainability goals. The company's financial history is marked by a consistent commitment to rewarding its shareholders through dividend payments. The payment of dividends is not a new practice, but rather a long-standing tradition that dates back over a century. According to the provided information, the company has paid quarterly cash dividends for more than 100 consecutive years. This demonstrates a strong focus on shareholder value and a willingness to distribute profits to investors. Furthermore, the mention of paying interest expenses and dividends on Dte Energy debt and securities suggests that the company is committed to meeting its financial obligations, including those related to dividend payments. In summary, the company's history and practices clearly indicate that it has indeed paid dividends, making it a reliable option for investors seeking regular returns on their investments. There are several concerns about inventory buildup or supply chain disruption. One major concern is the potential for fuel supply disruptions due to issues with natural gas, coal, and uranium supplies. This could have a ripple effect throughout various industries that rely on these energy sources. Additionally, price fluctuations in energy commodities and services can also cause supply chain disruptions. When prices rise, companies may struggle to maintain their current levels of production, leading to shortages and delays. Furthermore, supply interruptions for industrial raw and finished inputs such as copper and limestone can also disrupt supply chains. Extreme weather events pose another threat to supply chains, as they can damage infrastructure and disrupt transportation networks. Import tariffs and other trade policies can also have a significant impact on supply chains, making it more difficult and expensive to import necessary goods. These concerns highlight the need for companies to be proactive in managing their supply chains and mitigating potential disruptions. That concludes the financial summary for Dte Energy Company. Feel free to comment below, and I will be happy to answer them when possible.